Ourselves now. All right. Good afternoon, everyone, and welcome to the Aspen Institute. It's a hard thing. It's like if it rains, no one shows up for events. But then if it's a beautiful, gorgeous, sunny day when you can easily wander to the west end of DC, would you show up? So thank you, the hardy, the few who care about debt and debt financing in the United States, as you should. But actually, this is a great crowd, and we're just really thrilled to have everyone here. My name is Joanna Smith-Romani. I'm the Managing Director of the Financial Security Program, and we're one of the co-hosts for this event. For those of you not familiar with our program, our goal is to create the kind of policy and product environment that will lead to real prosperity for Americans. And we think about this in terms of how do we have families be stable in the short term, and how do we build that out to the long term, which is partly why today's discussion is so critical, because it's about homeownership. Is there something weird we're hearing? Oh, really? Maybe I'll walk back a little. Our goal is to create the kind of policy and product environment. Oh, we do. We are live streaming, so maybe you're hearing that a little. All right. Well, welcome to all of our live streaming friends, too. And we're all a family here chatting with each other. But so we're really excited about today's discussion and this work that my colleague Ray and others on the stage here have been doing to advance our understanding about the benefits and the risk of debt, because that really is a deep discussion rooted in the financial security of Americans and our economy. Just to real quickly plug some work that we're doing with Ray, with others that I think will be of interest to this hardy debt crowd, is through our Expanding Prosperity Impact Collaborative, so EPIC, at aspenepic.org. We've been in a deep investigation of issues around consumer debt for the last 18 months. And in fact, November 14th, we will be back here sharing out our solutions framework for how we solve this huge consumer problem in the US with other kinds of change makers and thought leaders, different from the ones on stage, but similar in how much work they're doing to advance these issues. So we invite you to come back then and look at more work we're doing on consumer debt at aspenepic.org. As I mentioned, this event is live streamed, so questions you ask and things they discuss will be witnessed by our friends all over the country, thank goodness, so we can give more access to folks. And I just want to again say welcome to the Institute, welcome to the Financial Security Program, and invite our senior fellow and my longtime friend, Ray Boshara, up here to really kick off this event. Thanks, Ray.
Thank you. Thank you, Joe. Really appreciate the kind introduction. My name is Ray Boshara. I direct the Center for Household Financial Stability at the Federal Reserve Bank of St. Louis. The purpose of the center is we really look at three questions. What is the status, the impact on families and the economy, and the future of family balance sheets? We felt that family wealth was relatively understudied, but increasingly important for both the well-being of families and the economy. When we say the balance sheet, we mean the full balance sheet, and we look at the debt side as much as we do the savings and asset side, which is, something we all really needed to do after the Great Recession. So today's event is part of our work looking at debt, and it's part 3 in what we call the Tipping Points Research Symposium series that we've been organizing in partnership with the Private Debt Project for the last 3 years. And part 3 of this is to sort of see how mortgage debt kind of went from being a relatively stable wealth-building investment for many years for many families and sort of tipped into a kind of a riskier investment. It's not always clear that it builds wealth. And so we've commissioned a lot of great papers, which will be available in probably a month or so when we get them all cleaned up. But we're really trying to zoom in on this question of how do we think about debt and its role in building wealth and its role in homeownership. So stay tuned. So yes, special thanks to Joe and all of my great colleagues at the Financial Security Program at Aspen. We could not do this event and this work without them, and it's an honor and privilege for me to be a part of it. And I do say my colleagues because as part of my portfolio at Aspen is to be thinking about the future of building wealth. Between my job at the Fed and my role at Aspen, I have 2 mandates to sort of think about the future of building wealth. And how can you think about the future of building wealth without thinking about the role of homeownership in that, since homeownership has historically been and remains the largest source of wealth for the majority of families in the U.S. However, we recognize that there are limits on the ability of earned income to generate sufficient wealth in this economy. We recognize that more families are taking on debts just to get by, and we recognize that homeownership isn't necessarily the wealth-building tool that it once was. So I think this is why we're here today, and we thought a great way to address these important questions about wealth and about homeownership was to invite three of our nation's premier experts on housing and homeownership to participate in what we're calling a keynote conversation. So my last job is and most important job, is to introduce one of those experts, Mike Seligman, who will then give a proper introduction to our other two experts, Paul Willen and Sarah Rosen Wartell. So Mike, I had very fortunate, Mike joined our center at the Fed as a senior research fellow earlier this year, and as many of you know, brings deep expertise and policy experience on housing and homeownership. As you can all see in his full bio, he was a senior advisor for housing both at the White House and at the Treasury Department for about a 6-year period, starting in 2012. He headed up the housing portfolio at the MacArthur Foundation. Maybe we have some grantees in the room, I'm not sure. And he's also a distinguished professor emeritus at UNC Chapel Hill, and from which he narrowly escaped from yesterday before the storm closed down the airport. So it wasn't an option for Mike not to be here, and he made it. So we're thrilled that he's here, and I've had the good fortune of working with Mike for over 20 years now, where we joined forces to try to get a tax credit to support IDAs many years ago. We almost succeeded, but we didn't do it. So we're really fortunate to have Mike and Sarah and Paul with us, and Mike, the stage is all yours. Thank you.
Great. Thank you very much, Ray, and thanks for the invitation to participate in this conference today, and I'm especially privileged to be moderating this conversation with two great people. Paul Willen is a senior economist and policy advisor at the Federal Reserve Bank of Boston's research department. While his research focuses generally on household financial management, he has done a great deal of work on the mortgage market, and his research on the origins of the subprime mortgage crisis have appeared in scholarly journals, been quoted on every newspaper across the country, and we're really thrilled to have him here. And prior to joining the Boston Fed in 2004, Paul was on the faculties of Princeton University and the University of Chicago, and he's currently a visiting lecturer at Harvard University. He's been a visiting member of the faculty at MIT, did his undergraduate work at Williams College, and earned his PhD degree from Yale. Sarah Rosen Wartell, also a graduate of Yale, earned her JD at Yale. In 2012, Sarah was named just the third president of one of my favorite think tanks in all the world, and that is the Urban Institute. Third president in its 50 years of the Urban Institute's founding 50 years ago this year. Is doing a fabulous job there. Previously to joining as president of Urban, Sarah was Deputy Assistant to the President for Economic Policy and Deputy Director of the National Economic Council. She spent 5 years from 1993 to 1998, and I overlapped with her in that time at the U.S. Department of Housing and Urban Development, where she advised the FHA Commissioner on single-family housing policy. And before her government service, Sarah was the founding chief operating officer and the then executive vice president of the Center for American Progress. So welcome, and thank you both for participating in this conversation. I'm going to ask a few questions of both Sarah and Paul. And as you hear and think about how they are responding to questions and whether that leads you to want to ask specifically something after our questions, we're going to open it up to the floor and hear from you, and we look forward to that. So let me start with kind of a big question, and we'll work our way to some of the more specifics as we go along. But let me start with, and maybe Sarah, you'll start and we'll rotate who is the first to respond to my question. So the big picture question is, why is homeownership such a successful vehicle for both housing and wealth building for most of the 20th century millions of families? From a policy standpoint, what did we get right? Sarah, why don't we start with you?
Well, thank you. And you know, when I had my first job in government at HUD in 1993, and the opportunity to get to work with Mike was one of the great pleasures, and to have become over time his colleague and friend in many different iterations of life, it's an honor. I'm very grateful to both the St. Louis Fed and Aspen for having me here. And as a think tank that's in the midst of our own space journey, to be able to visit your new wonderful facility is terrific. In fact, I looked at the space downstairs too, so it's fun for me to be able to see how beautifully you've used it. So let me ask that question by asking each of you to answer it for yourself in a funny way. Because I was thinking about this last night literally in my own family's journey. My parents purchased a limited equity co-op in a middle-income housing project in the Upper West Side Urban Renewal District in the mid-1960s. And they sold it 15 years later for the same price they purchased it for. Those were the rules in that program in those days. And they took that very, very, very modest savings that they were able to acquire while they were doing that and put it into a single-family home, and then sold that 8 years later at a ginormous profit, just luck of the timing, not everyone's so lucky. And that became the nest egg of the equity that my parents, now in their late 80s, are living off of. And if my sisters and I are lucky enough to have inheritance, it will have had its origin in that egg, little nest egg, through that story. And if you each think about many of your family's histories, I suspect those of us privileged enough to walk out on housing policy maybe have somewhat similar stories in their own family. So while it doesn't always work that way, and there are questions about whether it will continue to always work that way and work for everyone that way, one of the reasons this policy holds so much importance in our thinking is because my story is not the aberration. It is the norm for many, many American families. And it is true even today that while the wealth of African American and Latino families in the United States is a shockingly and tragically small fraction of that of American families, it is the case that as a share of their wealth, it is an even more important part. Home ownership is an even more important equity, is a more important part of the wealth of minority families in the United States today. So it is an important part of our sort of history. Why? Because it's for savings, because it's a hedge against interest rate risk. In many ways, particularly the 30-year fixed rate mortgage, to the extent that American families are able to be, if you were in rental housing, you were at risk of displacement with inflation and the chances of rent increase. It is protection against the cost of disruption that we sometimes undercount. If your rents rise dramatically or someone is doing something with the property, then you're not the decision maker and you may have to pay a great deal of money to relocate family. It does create, I think it's not a stunningly strong research record, but it tends to create the civic and cultural infrastructure of communities where people are homeowners. So in many ways, and properties tend to be better maintained. So for all those reasons, we have done a lot of things right, and homeownership has been encouraged by public policy. Now, a lot of the ways we've encouraged it have not been so smart. And I'll just quickly say that, the tax subsidy that we provide to homeownership has probably had less to do with the amount of homeownership we had and more to do with the price of homes and the amount of house we all choose to buy. And the benefit of that tax subsidy certainly is not terribly well distributed. We'll talk more about later. And I guess the last thing I'd say is that if I were looking at a whiteboard today and designing a wealth building incentive mechanism, the last thing I might choose is homeownership, even with all the virtues that I've described, because it does expose people to risk, and there's a lot of profound inequities in the way who we incentivize and the ways it reinforces structural challenges in our economy for many people. So I'm not saying that it is the ideal system, but it is the system we have, and I spend a lot of my time worrying about the fact that it is a system that more than anything else, unfortunately, is reinforcing many of our inequities rather than creating more opportunities. And I'd love to be able to have a whiteboard, but if I don't, I want to work within that system to make it more equitable.
Great, thank you. Paul?
So, do I get my slides? Is there anything there? Oh, there we go. Okay, so actually, most of these slides, I'm not giving a slide presentation. Most of them are, most of them are here. Well, there we go. Wrong direction. How do I go backwards? Oh, left arrow. Okay. So, I'm starting by saying that I'm here today as a concerned citizen and as a researcher, and not as a representative of the Federal Reserve. So that's something I say even when I'm in Boston, but it's especially important here, and especially for this discussion, to know. So I'm not speaking for Jay. Okay, so what I wanted to just make 2 points. So this is kind of broadly on the question of what have we gotten right. So I'm reusing some slides from other presentations, but as you'll see in just a second, why do we have? So the question that was posed for us is why do we have this institution of debt-financed homeownership? And so let me try and explain that it is itself, we don't really have that much of a choice. So let me explain why. So households, what we consume is not the house, the whole thing. What we consume is the flow of housing services. And so when you rent, you're renting a flow of housing services. Most of what we do in life is flow. We earn income in a flow. We need a flow of housing services. We need a flow of services from a car. So when you rent, you get the flow of housing services. When you buy, you don't just get the current flow of housing services. You get all future flows of housing services. So you're basically buying something you need right now and the right to use that for the rest of time. And so for an analogy, renting, when you buy, so this is the flow of milk, you can see, probably guess where this is going, it's blinking, is that when you rent, you buy, is like buying milk, so you need milk, you buy milk, and ownership is basically buying a cow. And so the point here is that we don't need the cow, you just need the milk. And so the easy way to do that is through renting. But there are inefficiencies with renting, which Sarah just mentioned. You don't control the property. You don't, it's always a breakup of ownership and control. So there's someone who's the residual claimant, which is the owner of the property, but you're the one who's managing it, and that causes all kinds of problems. So there are a lot of things about ownership that we like. And so what does a mortgage do? A mortgage basically converts the flow, the ownership, the bad parts of ownership it converts it into the bad parts of renting, the bad parts of ownership, that you have to buy the whole thing. It basically allows you to make a flow payment to own the property. And so you can think about it, one way to think about what we do with debt basically is that the landlord, so in the old system, you have a landlord who rents the property to you. They have lots of assets. They can own the property. They need the income and not the asset. And you need the asset, so they rent it from you. And the alternative with a mortgage, basically what the landlord does is lends you the money. You buy the house from the landlord, and instead of paying rent, you pay interest. And so the point about it is it's important to understand that I don't think we can, or at least in my opinion, I don't think debt finance homeownership, that's a good thing. So if you want to know what did we do right in the last 50 years, well, that's one of the things. We created this institution that allows people to own property, to have all the benefits of ownership, but then make a flow payment the way they would with rent. Okay, that's the first thing I wanted to say. The second thing is I wanted to talk a little bit, actually, I guess about the crisis. Well, let me go back. A little bit about the crisis, and to say that a mortgage, we've come away from this thinking a mortgage is a terrible thing because of all the defaults. But it's important to understand that in a way, a default is not a bug of a mortgage, it's a feature. And let me explain why. So a standard mortgage contract has a risk-sharing feature, and that is the default option. And so if you own a house that's worth $500,000 and you get a mortgage for $450,000, you have $50,000 in wealth. And if the house falls by $100,000 in value, the house falls $100,000 in value, and your mortgage balance stays the same, and your wealth falls by $100,000. That's bad. So your house value fell and your wealth fell. So what do we do with a mortgage? We introduce this option to walk away from the house. And what happens? Well, the value of the house you own goes to zero, but the debt you have goes to zero also. And so instead of losing $100,000, you actually only lose $50,000. And so what does the mortgage do? The mortgage, the default feature allows us to have this system where you can own a property and make this flow payment, and the default option, in some sense, insures you against falling house prices. And so we actually went to the data to compute this. And so this figure shows housing wealth changes. This is based on a sample of all private label securities, and we used those mortgages from private label securities because actually they have the best data, which has always been one of the ironies about this. And so we have the housing wealth change is on the x-axis, and the change in financial wealth is on the y-axis. And without any risk sharing, you have the household absorbs all of the change in wealth. If there were full risk sharing, then the financial markets would absorb all the wealth, all the risk. Okay, so what happens in the real world? In the real world, what happens is, this is from the data, is when house prices go up, households keep all the benefit, and then when they go down, what's that down there? What's happening? Why is it that their wealth isn't falling when house prices fall? And that's because of default. And so basically, because we thought it's a bad thing, and I'm not saying that it wasn't a bad thing in some ways, but it enabled people basically to walk away from their mortgages and to walk away from their obligations. And so their fall in wealth was relatively small. And let me just say, the point here is the more leverage you have, the more risk sharing went on. And so the higher your loan to value, the more you're walking away from, and the more risk sharing went on. So anyway, that's my take on what we did well. And let me just say the last thing is, I think we also need to understand about what went right. I grew up in New York also, so I have a similar story. My wife grew up in Boston, but her aunt lives in Cleveland. And so a lot of this is luck. The last 50 years has been an extraordinary period of house price appreciation. So to say that, my mother, to call it a nest egg, my mother was just incredibly lucky. about where she happened to live and when she happened to buy a house. And so to call it wealth building is a little, if I can use the word, it's a little risky because in a lot of people's cases, it wasn't wealth building, it was just they happened to be in the right place at the right time.
So I just wanted to add one thing, and I agree with almost all of that, so I'm not disagreeing at all. The key idea, though, is that most average Americans don't get access to the primary way in which people in the capital markets do make profit, which is by taking risk and getting access to leverage. And this is a point Paul's made in other contexts. Home ownership is one of the ways in which moderate income Americans are able to gain the benefit of leverage and be able to take some risk and get some upside when the conditions are right. And that if we think about ways in which we deny people access to a mode of risk sharing and leverage to build wealth, and only let those who have so much capital that they can afford to risk it all do that, we will further exacerbate the extent to which the winners in society are only those who can play in that game. And so while this system has lots of downsides, entry into it is entry into the way that others are able to build wealth.
Thank you. Let me ask you a question. I'm going to give you a fact and then a critique of government role in housing based on this fact, and then ask you how you would really assess the argument. And the fact is that today in 2018, our national homeownership rate is about at 64.3% or so, is about where it was 50 years ago in 1968. So basically no net change. Lots of debate today around the role of government in the mortgage market and housing finance, and much of that revolves around the future of Fannie Mae and Freddie Mac and whether we need a government guarantee and all those kinds of things. A growing argument among those who don't believe in the necessity of a strong continued federal role in the mortgage market point to this homeownership rate and say, over the last 50 years, the federal government, directly and indirectly, has invested billions and billions, if not trillions of dollars in the support of homeownership. And what have we got out of that? Basically nothing. All of it a huge waste of money. And therefore, as we think about the future of the mortgage market and housing finance, what we have to do is pull the federal government way back out of the market, not really continue on this terribly wasteful path. That is the argument I face all the time in the housing finance. I'd like you reactions to that argument.
Do I go first? Okay. So I think there are two answers to it. And I'm not going to really come down on either one, but they're yes and no. So I think one question is what the counterfactual is,
Yeah.
which is obviously there were lots of subsidies before 1968, and so the assumption there is that, if we've maintained the homeownership where it is, that was the goal, and we achieved it. The alternative, the other answer, and I think Sarah in some sense already said this, is, so I had one slide, I just pulled this up this morning, but is that the United States, where is it here, is that the US, I just got this is not my own slide, is that, and you probably can't read it, is that, this is what I get for making the slide this morning, the US is not unusual in its homeownership rate. And so there is a question of whether all these subsidies are really going to increase the homeownership rate or they're really just going to subsidize the people who would own homes anyway. And so it may be that, in fact, it hasn't had any effect on the home ownership rate. It's just allowed homeowners to live in bigger houses and spend less on housing. And so if I think you can't really read what's on there. It's just to say the United States, the homeownership, as many of you I'm sure know, the homeownership rate in the United States is not exceptionally high by international standards. And I always think it's funny that we keep talking about homeownership as being the American dream, because actually I think you could argue it's the Romanian dream or the Irish dream, but there are plenty of countries with much higher homeownership rates than we have. I think it's everybody's dream. I don't think there's anything uniquely American about it.
So I get those kinds of questions in lots of things. We shouldn't have had a war on poverty because we still have poverty, for example. And that's one I get most often. And the fallacy of the question, I understand your frustration having to deal with it about the point we don't have a counterfactual. We don't know what the circumstances are. We don't know what other forces were acting. But I think if you take the smart part of the question seriously, if not all of it, and there is a smart question, which is which of our various ways of trying to promote homeownership have beneficial outcomes and which do not. We've done that in a number of ways, and they have had a mixed record of outcome. You've heard me already talk about the upside-down tax subsidy, and we have upside-down tax subsidy in homeownership. We have upside-down tax subsidy in retirement, where we give the biggest incentive to save to the people who have the most means to save, and therefore who save the most using the benefit, but query whether they would have saved anyway. And so I think that I would argue that our use of our tax subsidy today, as it's currently designed, many people have worked on other ways to design a tax subsidy so that it encouraged the benefits of wealth building at the bottom and not at the top. Lots of ways to do that. But we saw how hard it is to make changes in our political economy on that. Whereas some of the other subsidies that we've discussed, such as the implicit subsidy that is involved in the indirect government guarantee of the GSEs, or the direct subsidy that is involved in our guarantee of the FHA and VA and others, has been a relatively efficient subsidy because the federal government could spread risk over time. So even when there are moments when we do bear, and there are opportunity costs, certainly, but when we do bear that risk and we have to support the mortgage market or the GSEs temporarily, we generally get paid back. And so that we are sort of using the government's broader shoulders. And I know economists will argue to me there's a constant payment that we're making essentially in the mortgage market. But I would argue that's a pretty efficient subsidy as opposed to the tax dollars that we've spent other ways. We could design it better, we could protect the taxpayers better, we could align risk better, we could do a lot of things better, but that's a different kind of subsidy. And then the third thing is that those policies have unintended consequences. And the textbook example of that is FHA, where we did, I would argue, probably significantly encourage homeownership for many decades. And we did it in ways that reinforced redlining and created some of the legacies that we now face with exclusion and access to wealth building at one time in history that we're now trying to remedy. In more recent years, the heavy use by minority communities of FHA as the lowest down payment entrant into the mortgage market may have had some benefits, although there's been some, even within that market, some steering to higher cost products than was necessary. So there's a lot to unpack to make sure that we understand the way these tools work in their specifics. But I still think it's important to distinguish between different ways we've supported the market and which ones have been more efficient and not.
I'd like to keep that slide up for a minute and talk about the uniquely kind of American mortgage, 30-year fixed rate, prepayable at any time, with the Romanian dream. We are one of the few countries, right, with that 30-year fixed rate. We have a number of countries that don't have the 30-year fixed rate mortgage, that have higher equal or higher homeownership rates. The 30-year fixed rate and the preservation of it has become really a stake in the ground for thinking about future housing finance policy and reforms. How important is it, in your view, to preserve this form of uniquely American mortgage financing, the 30-year fixed rate prepayable?
That's my turn. So this one is harder because of the slide. It suggests to me that it's less important than we all believe. But having said that, many of the features that I described as desirable about homeownership, in particular, in essence, you remember when people sign up for a fixed rate payment, in a world in which we've experienced only gradual and then higher levels of inflation, in essence, your payment is going down over time, so it creates all kinds of opportunities for people to buy now a price of housing that they can lock in over a period of time. It's actually one of the features of the mortgage market that actually helps protect people against risk in a world in which we are increasingly, in every other way, 401ks, et cetera, putting risk on the home buyer. And so it has a lot of things that from a consumer's perspective are very desirable. And I know that anytime I have a choice between a variable rate interest, and I'm privileged to have the choice, I'll pay a little bit more to have that assurance about pricing. And the fact that that's desirable to me seems to me as an indication that, and I don't think I'm deceived, I'm a rational actor in that sense, and I'm buying a protection against risk. I think that having that as a choice, does it need to be the dominant choice? I'm not sure, but we did see certainly when we had a much higher rate of variable rate interest mortgages that there was a lot more that tended to go to the parts of the population who are least well able to protect themselves against those kinds of risks, and we had more volatility.
Paul?
Okay, so one thing with the 30-year fixed rate mortgage one fact is that almost nobody keeps these mortgages for more than a relatively short period of time. And you know this when you're using the data, because every now and then you get one of these loans, and you have 1 million loans, and so you've never worried about it, and one of these loans actually pays off in the 360th month, and your program, and you get like it's a negative. The program goes berserk because it's never seen that, and so I think there's something in between. I mean, the point is people are paying for insurance essentially that they're never going to use. Most people don't live in houses for more than, the median tenure in a house is not that long. So even just the fact that people are going to move alone means reduces the benefit. The other thing I think we did see during the crisis was that, it's ironic, but when we cut interest rates, the benefits of that were not shared by a lot of people because they couldn't refinance, either because their credit was damaged or because they had negative equity. And so one of the things that was amazing was that people who had adjustable rate mortgages, essentially they got a loan modification. They got their payments cut in half without having to do a stitch of work. They didn't have to call anyone, they didn't have to do anything. One day their payment went from $1,100 a month to $600 a month, and we can see instantaneous, dramatic reductions in defaults when that happened. So that's the second issue. I think there is something in between. I mean, the 5-year or 7-year fixed rate, what everywhere else in the world they call fixed rate mortgages, but we call adjustable, which is a mortgage where the payment is fixed for 7 years or 5 years. I think that gives you a lot of the benefits without the costs that I've mentioned. One other thing to say is that the fixed rate mortgage, the 30-year fixed rate mortgage was a real problem in the late 70s, because when inflation is 15%, basically you're in real terms amortizing your loan over 5 years, and if you go back to the rent versus own, basically you don't really get that out. You can't just pay the interest. You're basically buying the house over 5 years.
let me go back to the what we did right and wrong on the build-up to the bubble and the crisis. Where did we really go off the rails? Sarah talks about the upside-down tax benefits. That existed long before the crisis, and fixing that problem is kind of a purely political one, but where did we really screw up in the asset bubble and the contribution of policy to that?
I have to take this one first. I would say that, well, let me say as an economist, so the bubble is the event. So this is not as an economist. I think we all know the bubble, the boom, and then the bust was what the crisis was about. So as an economist, I want to say that we have little or no understanding of why we had a bubble, why it started when it started, and why it crashed. And I think there are economists who would disagree with me, but I think they're wrong. You know, when you take a finance class, there is no one teaches, there is no link between credit and bubbles. That is not part of anyone's training in economics. There is no theorem that says that when you make it easier for people to borrow, it's difficult to even show that prices will go up at all, let alone that you'll get prices doubling relative to rents in 5 years. That is not something economic theory tells us. I'm not saying that I'm not proud of that as an economist. It's embarrassing. I mean, if you go to a finance class, half of what you do are puzzles, which is what we say when we have something that we don't understand. We then, you know, someone gets a puzzle named after them, and that's great for your career. But it's not great for if you're trying to understand what happened. So in terms of, do I think there were things we could have done? Yes. There were all kinds of things in hindsight that we could have done, and even at the time, but it's difficult. I think one of the problems of the bubble is it infects the policy community as much as it does the borrowers and the lenders. So everybody thinks this is great, and it's very, very hard to fight against that. And one of these examples, they had that program in Chicago at some point where they tried to introduce all kinds of counseling requirements for people to get loans. And in ex post, the people who had to go through those counseling programs actually were much less likely to default. Everything you would want. But the people hated the program so much that they had to cancel it after 4 months. And I think that's the challenge that we faced in 2006. It was very difficult, as I say, not just among the borrowers and the lenders, but among the policymakers as well.
I completely agree with this idea that in some ways that the challenge is a cultural one and a mindset one as much as one of the economics or the math. There were facts in front of us at the time that we saw, and yet when we saw them, we looked away. It could not have been the case that we believed that when we were slicing and dicing risk and creating these swaps and secondary mortgage market instruments, that we were going to be creating efficiency. And that efficiency of finding the person who could perfectly bear risk was going, but we created such an enormous volume of those instruments, disproportionate to the amount of underlying mortgage risk. And there was this enormous run-up in house price that none of the underlying facts in the economy. And there was a mindset that said that somehow these instruments were creating there were a goose that was laying a golden egg, and we weren't sophisticated or smart enough in the policy world to understand. There were people in communities who were saying that equity is being stripped in our neighborhoods, and that people are being incentivized to take out products, that there are predatory actors here. And yet, we didn't know how to respond to those pieces of evidence. I don't think, when we look back at which mortgages went bad and which ones really cost us, the ones that cost us were predominantly the refis and the exotic product design. It was not predominantly the amount of credit risk that lenders were taking. It was what Laurie Goodman and the folks at the Housing Finance Center call product risk, and this sort of enormous set of incentives of people to generate and create new product so that the fees would be paid and the instrument would be passed on to somebody else, and no one really cared about whether there was a sustainable product at the end because you didn't hold on to it. So we had a lot of incentives wrong, and we weren't reacting to the facts we were seeing at the time. But I think we learned some bad lessons because we thought what we did was we mostly extended to a class of people who aren't ready for homeownership, bad people who shouldn't have gotten loans, and we've overlearned a bunch of lessons that really weren't true about what happened there.
Yeah. A major theme for those of you who are here just for this session, a major theme of the conference that we are participating today is that we've become too reliant on mortgage debt. Our housing finance market, our homeownership market has become too reliant on mortgage debt, and that incentives really are working in kind of the wrong direction to the detriment of household balance sheets. And so my question to each of you is, are there, given the high cost of the cow and the long economic life, really, of the assets, a mixed metaphor, what are alternatives? Are there useful alternatives to a debt-dominated homeownership market?
So this for me. So I guess I would say there are some interesting innovative products out there. We've done some evaluations of shared equity models that, while it's not a strong evidence base, suggests that for some people those can be encouraging. That's essentially what my parents did as their first step on the ladder. But you're also asking, on a lot of those products, not all, you're asking people to give up a big chunk of the upside as well as the downside. So some of the benefits we were talking about as a wealth building tool are, and the private capital tends to take for the amount of risk they're taking, they take a bigger slice of the upside because their cost of capital is higher than the consumers. And so you end up with a bargain that sometimes doesn't quite feel right, especially when there is a lot of upside. So the way I tend to think about the right solution, and there are rent-to-own models, although some of the guys in that business are really more interested in the rent-to-rent with the marketing attraction of own, but reality of it being limited. So I tend to think about how do we do something instead, which is we don't try to run away from mortgage debt, but we try to make mortgage debt work better for the consumer. And so I think about the things that get consumers in trouble. And some of it you can't help. It's like you lose your job or some family member gets very ill and you don't have the income anymore. But some of it is also, do you have a rainy day fund to deal with damage to your roof? Do you have a way of dealing with the break in your employment earnings, or do you get caught up behind? And there are kind of creative and interesting ways that help people build savings into the run-up to the purchase of a home and savings into the actually maintenance of the purchase of a home that I think are worth exploring.
So as a game changer, no, I don't think there's anything out there. I mean, one of the things. So one of the things, as Sarah mentioned this before, but I mean, housing as a hedge against rent risk. If you grew up in New York, there were people. If you weren't an owner, then you're progressively over the years moving to smaller and smaller houses, or unless you leave. So in that sense, that's, again, one of these features of home ownership that we want to keep, and all the shared appreciation, all these things, there's no free lunch. They erode that. And so I don't, so I don't think I think that, again, the rent to own, it always seems very appealing intellectually because it has, if there's a fixed amount, if the borrower has an option to buy the house for a fixed amount, then it really actually captures a lot of the optionality, all the benefits of home ownership, and in some ways, in terms of, at some point, you are the residual claimant on the house, so investing in the house makes sense for you because you'll capture all that because you have the right to buy it at a fixed price. My understanding is from talking to people at Fannie Mae and Freddie Mac who've tried it is most of the time the homeowners the renters just never use the option. So it's a nice idea, and like all these things, they're nice ideas, and you can write down a model or something that says it's good, but people, given the choice, they just don't. They don't like them.
And just one point to the firm. Work from Elena's colleagues has pointed out that in 50% of American cities right now, it is actually cheaper. Your monthly cost to own a comparably sized house is less to own than to rent. We have such a we haven't really talked about the supply constraints in the market, and it's not a perfectly fungible market between rental and ownership and between different parts of the market, but the supply constraint on the rental market is such that people, to get a 3-bedroom apartment, are paying so much that they would actually pay less. And so the barriers to home ownership are also essentially the high cost of being middle class, let alone the high cost of being poor. You're requiring people, if they can't gain access to home ownership, to pay more than the value in some ways of the asset that they're acquiring.
I'm going to ask one more question, and we're going to open it up if you have any questions. This is about manufactured housing. Given the high rising housing prices, now we're in a rising rate environment. Manufactured housing, it seems to me, might become a much more critical source of affordable housing. And if you kind of look at the financing market for manufactured housing, to this day, most manufactured housing is financed through high-cost personal loans called chattel loans. The lien is placed on the home itself, not on the land. Consumer protections that go with mortgages really largely do not apply. Loss mitigation is very, very different and more challenging. The finance market, the supply of manufactured housing finance, very concentrated among very few lenders. Some really are subsidiaries of manufactured housing producers. In any event, as part of their duty to serve obligations, to serve underserved markets, one of which is the manufactured housing finance market, the Federal Housing Finance Agency, Fannie Mae and Freddie Mac's regulator, are encouraging the GSEs to get involved in creating a secondary market for chattel loans, to provide more liquidity and hopefully lower prices and perhaps more consumer protections for those who rely on this kind of financing. My question to Paul and Sarah can't comment on some of this because of kind of a conflict, but of interest that she can speak to or not. Is this good policy, Paul, for getting the GSEs into the chattel loan market?
Well, so I'm not an expert on chattel loans, but I will say that I think that to some extent the consumer protection benefits of mortgages are much more limited than people think. And so, for example, people, you know, the mortgage law, this ancient English law we have, was designed to protect people from losing equity. I mean, that's what they were worried about. That's what all the law is about. And that's not an issue for most people who default on their mortgages. They have no equity. That's why they're defaulting on the loan. And so there's a lot of stuff out there, a lot of the protection which people, I remember you would read these stories about people who would go to court in judicial states and find that all the court wanted to know was whether you'd taken out the loan. There was no discussion of whether there was any fairness or anything. It was just a question of whether you had taken out the loan and whether you defaulted on the loan and whether this lender was in fact the person to whom you owed the money. That was it. There was no other conversation. So I think it's easy to overstate the benefits of calling something a mortgage, and this is pure speculation on my part, but in a lot of the loss mitigation stuff, as you may recall, happened in the crisis. A lot of that stuff was not in place before the crisis. A lot of the rules we have now were not in place, and to some extent those rules came from Fannie and Freddie. I mean, the fact that Fannie and Freddie have that are the ones who will decide what goes into securities, and they can make the rules. So, you know, obviously, I don't want to be, you know, responsible for the great manufactured housing loan crisis of 2021. So, that's pure speculation on my part, but that is a role that Fannie and Freddie have played that has been positive over the years.
So Mike was alluding, my husband works at FHFA and oversees the division that does the duty to serve rules. So I'm not going to comment to the rules, but I know a lot about manufactured housing. When I worked at HUD with Mike, Henry, I oversaw the program that regulated the consumer standards for manufactured homes. And Henry Ciceros used to call me Miss Manufactured Housing, and I would say to him, actually, no, there is a Miss Manufactured Housing. She wears a bikini and a little pageant bar and stands on top of a Fleetwood, so you please don't confuse me with her. It was not likely to happen. So I do have a few, I want to put a couple facts on the table about manufactured housing that I think go to this question. That it's a really interesting part of the housing market that, you know, those of us who still have sort of homes with headlights in their mind perhaps really are not quite doing it justice. You know, the cost per square foot to construct a manufactured home is 35 to 47% lower than the rest of the market, right? So in a time when we have had zero innovation in construction and manufacturing of homes, although I think that's starting to change. It's interesting. Silicon Valley money coming into the building markets. But in a time when we've had very little innovation in how we build, manufactured housing is an important potential supply contributor. It is true that 80% of the mortgages for manufactured homes are chattel mortgages. But a surprising, and this is again work from the Urban Housing Finance Policy Center, surprising share of those are for people who actually own the land. So it is not necessarily the case that it is not impossible for those people to be mortgage market. There are various reasons they may not like to. The one I can put my head around is, you know, a family owns a farm and their kid is going to put the manufactured home on a field. Well, maybe you don't want them encumbering the whole farmhouse with that. So there are reasons why people don't want to do it. But it also may be, and credit standards are higher. But there also may be a significant amount of steering, particularly given the relationship between the chattel mortgage lenders and the originators. So it seems to me that with some counseling and some public education, there is some real opportunity for us to move more of the manufactured housing to site-built housing finance. And that actually, and this is work that really surprised me and goes against my own perceptions, that in fact, we think of manufactured housing as I've always said, is a depreciating value asset the minute it moves off the lot, and that's actually, the numbers suggest that may not be true. That the home, that much of our appreciation is in the value of the land. And so the homes do not appreciate anywhere near as fast, but Lori and team have done analysis of some data from FHFA, and they see that in fact the homes are appreciating, and the Lincoln Land Institute suggests that while land may appreciate 200%, that there's still they saw 87% appreciation in the value of some of the structures. So it seems to me that we need to better change our mindsets and understanding of this, as well as kind of reopen our minds to the supply chain possibilities of rethinking the site-built models as well.
Thank you. Do we have time for questions?
Great. One quick remark, maybe a question to Sarah and then to Paul. The word financial stability hasn't been mentioned once on this panel, which I found very telling. So we've had a big crisis that put lots of people out of work, millions. It took years to recover. The GDP losses are enormous. But it wasn't worth even a sentence that debt-financed home ownership might have sort of knock-on problems for financial stability that we need to think about. The other question is maybe more to Paul. There's a nice cow picture, but what do you do if the value of the cow appreciates over time? Like if your cow, people just raise more cows, so the price never goes up. But if you have sort of trend increase in land price, you have in land prices, can't make a second Manhattan, then the sort of the equations look different, and you sort of have a lot of debt accumulation over time that could be problematic.
So I'll just make, for those in the workshop, I'll just encourage people, I think Karen, and I know she had a co-author, and I don't mean to, a paper on this topic is, I think, really quite good. Obviously there are, I wasn't in the questions we were asked, but I think there are significant financial stability issues. But I think we may undersell the financial stability issues of having a lot of people who are renters before, and I did perhaps, I think that vulnerability to consumers of the risk is not something we should undercount. I also think that a lot of our mistakes, a lot of the mistakes that we made in responding to the run-up to the crisis and to the crisis itself was in our lack of understanding between the real economy and the housing market. And there's a policymaker who shall go unnamed who said early on in the administration that Mike served in later that if we just stabilize the employment market, the housing markets will follow. And what we learned in the crisis is, to your point, the degree to which those are entangled. But if we had believed that going into the crisis, we might have made policy and we might have looked at some of the factors of risk very differently. So I agree that they're very closely entangled, but I'm not sure that therefore means that we should not, and I certainly think we should be much more prudent about the degree of the solidity of the debt that we have. I worry a lot more about the declining level of equity that people have in their homes today, how low down payments are, than I do about credit risk. We have way over-constrained the credit box, I believe, relative to where we need to be in this market. But I think what we've done instead is we're seeing lower and lower down payments, and that worries me. So we ought to be thinking about those stability risks as we're doing policy in those areas, but I don't think that leads you to a conclusion that debt finance mortgages are the wrong tool.
Paul?
I was going to say, just when Michael sent us these questions, each one of them I looked at and I started to write down a few notes, and then I thought, we could probably have a whole conference just about each one of these questions individually. And so one of the reasons we didn't get onto financial stability, I think, because we could spend all this time discussing financial stability. So I'll only say that the transmission, it's another one of these things that we don't totally understand, is the transmission of why something happened in the fall of 2008 that turned what was up to that point a relatively mild recession into the Great Recession. And I think in my opinion, the issues that led to that were conceptually separate from the issues of debt-financed home ownership. So going back to on your question about increases in prices, I mean, at the end of the day, I don't know how many people here are familiar with the concept of the user cost from economics. And when we teach user cost in macro, we're always thinking of the user cost. It's the interest rate plus depreciation, because the asset that you have depreciates. But housing, as you say, appreciates in value. And it's true that that's one of the things that contributes to the debt, because the faster you think the asset is appreciating, the more valuable the asset is, the more debt you take on, because you anticipate that the cost of that debt is going to be paid for by the appreciation of the asset. And so is that a bad thing? Again, it's hard to say. Were we just lucky for the last 75 years? I don't know. One thing, it's funny when you look at the history of Manhattan, since we're both from Manhattan, is how many times house prices have been rising in Manhattan now for several hundred years, and they have these punctuated by episodes where they fall, but then they always come back. And so it's a bit of a puzzle why it is house prices have been rising so fast for so long in these places. But I think it is also important to stress about the housing market in the US, how different the experiences of different places are. My co-author and close friend, Chris Foote, grew up in Wichita, Kansas, and I grew up in Manhattan, and our parents bought houses around the same time. And we're always joking that the user cost of capital for my mother has been negative for all these years, and that is not. And so his parents live in a nice house in Wichita. My mom lives in a house in New York, and my mother has paid less for it than his family. So I don't know what to.
This
Robert?
is a pretty quick one. Just wanted to call attention to a kind of collateral market and see what you guys think. So we usually talk about, when we're talking about housing and housing finance, we usually talk about demand for mortgage credit and supply of mortgage credit. But there's also demand in the collateral market that accounts for a lot of the supply of the mortgage credit, it seems. And that's the demand for safe assets, right? And it does seem rather interesting, right, that the repo markets and other markets that have substantial need for safe assets ran out of treasuries around 2006, 2007, creating enormous demand for other perceivedly safe assets. And so I'm wondering what role, if any, I assume you think it played some, but how big a role do you think the demand for so-called safe assets played in actually generating the housing bubble itself?
That's a good question, but not one I feel very well suited to answer on the fly. I want to think a little bit more about it. The anecdote that I'm reminded of is which is a slightly separate issue, but there was a lot of things that weren't necessarily economically rational behaviors happening at that moment, and one of them was the desire to retain clients. So, Fannie and Freddie for a long time refused to purchase certain types of assets. And then when their supply, meaning the Angelo Mazzillos of the world, say basically, you buy these crap products, which were not safe assets, or else I'm going to deliver everything to the PLS market. They took risks that they had never taken before. That was their economic. They were starting to behave economically rationally, and then sort of holding onto market share and perceptions. So I'm sure there are analogous ways to that same set of problems in the market that you're describing there. I just haven't thought enough about it.
I would, as I said before, I think the answer is you could spend a lot of time. Certainly, as an economist, I have no idea. You could spend a lot of time studying it, and you still wouldn't know.
Go ahead. One more.
Yeah,
Go ahead.
Larry Checo Communications. I'd like to take issue with this notion that nobody saw this coming, this bubble coming. I think that, and I took this up with Alan Greenspan at Brookings a couple of years ago, but housing prices were going up 10, 15, 20, 25% a year. Wages remained relatively flat. To Sarah's description, people were being sold crap mortgages. There were people who knew what was going on. My friend Robert Burns here and myself happened to work at NeighborWorks during the crisis period. They were screaming that people were going into these neighborhoods and basically stealing houses through these crappy mortgages. Paul's mother was smart enough. I'm going to bring your mother into this, Paul. It's okay. Paul's mother was smart enough not to be captured by somebody going in there and saying, Mrs. Martha,
You know, you bought this house for $100,000, you know, 25 years ago. It's worth 500, 600, $1 million now, whatever it is in New York City. I got a great mortgage for you, you know, and instead of getting a great mortgage, she got something that reset at something that she could not afford. A lot of people got caught in that trap, and I lay this at the foot of government watchdog agencies. The Fed, the SEC, Fannie Mae, Freddie Mac, the credit agencies, from appraisers to agents to brokers to bankers, nobody had any skin in the game. I would sell you anything if I knew I couldn't take a loss on it.
Well,
So come on. I
think
mean,
it's-
there's
wait, I
some
just wanna
people
say-
knew this was coming, and it's almost
I want-
insulting
wait,
not to say that.
I always bring this up. The financial system lost $1 trillion on those mortgages.
And they
So you-
deserve to lose it. They
Pardon?
deserve to. They deserve to
Well,
lose
You
it.
just said they had nothing to lose. They lost $1 trillion, so they obviously did have something to lose.
So let me just,
So if they
It's-
thought that, they were wrong.
so this is the one place I think, Paul, that there's any difference here at all. I do think that people saw it coming. Some people saw it coming. I also think that culture is as powerful as math, and that it was in the culture at that point to believe that markets were inherently creative, that they were much more sophisticated than policymakers and regulators, and that somehow or other that there'll be inefficiencies introduced if we were to try to regulate parts of the market. I mean, you know, in 2002, no, it had to be earlier than that. End of 2000, Larry Summers and Andrew Cuomo wrote a report about predatory lending practices that went to the White House. And if you look at that list of, the recommendations that were in that report, I mean, it would have just nibbled at what was to come, but they were already seeing signs of it, and none of those recommendations ended up going forward anywhere.
It even named the lenders
Right.
that were doing the predatory lending.
Right, and
that
so that
report.
it is, I think we absolutely, many of us saw it coming, but the broader culture at that point, the sort of underlying distrust in government and the sense of its lack of sophistication, one of its great costs was the belief that regulatory policy always somehow is inefficient and gets it wrong, so we're better off trusting the market. And the consequences of that is the result you described.
Back there, yes, sir.
Yes, I realize that this is pertaining to a small part of the population, but I'm curious to know your thoughts on the home equity conversion mortgage and some of the new proprietary products that are much different than what was available in the past and are becoming available for the purpose of helping those seniors who have houses of $1 million plus. And we kind of rely on the FHA insured program for the less expensive homes. So in the scheme of things, I'm just interested in what your individual opinions are on that particular program.
do that?
I actually
Don't know.
defer to you. I
Okay,
don't-
well, so, and I must admit, I have a day job these days that I don't get to do as much of the following these markets as much as I wish. But the short version is, I think in concept, a HECM reverse mortgage can be very valuable for a portion of the population who wants to access, and as I have an aging parent, I understand, want to access the equity in their home in order to be able to continue living there. There are aspects of the products that are both dangerous for the homeowner. A lot of them end up having equity stripped, and dangerous for the market. I mean, that was the thing that brought the FHA Mortgage Market Fund negative. Was if it hadn't been for the reverse mortgage portfolio, FHA would never have had to dip negative. There are a number of new products. I don't know enough about them to know whether they're beneficial. I hope we can get this market to work, but I hope we also have enough constraints on it that we're ensuring that the people who are getting it understand the risks they're taking and are doing it sort of in optimal circumstance.
So a quick comment on luck and a quick question on American exceptionalism. So my parents in the 1970s, early 1970s in South Carolina were very lucky when they were looking to buy a home, but they understood that no amount of luck would have allowed them to buy into certain communities, that's actually most of the desirable communities. And we also know that although there's no longer the categorical exclusion so much, there's a lot of steering. Okay. On the American exceptionalism, we get a snapshot, but we don't see, in this figure, we don't see changes over time. So we don't know if there's a diffusion story. And the other thing that we don't know is whether or not there are differences in government supports for homeownership that might be exceptional.
So I'll make first of all, you're exactly right about the ways in which luck is not all luck. In other words, we certainly, for a long time, helped people. Although I have seen that the perception that even I had that property appreciation was not always as strong, sort of absent the predatory practices in some of the majority minority communities is actually not right. Lori has taught me that, in fact, there's been strong home price appreciation. There's been a sort of a wave of academic discussion about, well, we shouldn't encourage people of color to buy homes in largely minority communities of color because actually those homes don't appreciate as much. And well, that's structural racism if that's true. But in fact, I'm seeing data that suggests that that's not the case. On your American exceptionalism point, the one comment I'd make is that a lot of people argue the United States supports our mortgage market so much and so many of these other countries don't, and they do just as well. And I think we always have to look at the different ways. So when you have a banking system in Europe, for example, where the implicit guarantee isn't on the mortgage, the implicit guarantee is on the financial institution making the loan, you can't really say that we don't guarantee mortgages and therefore it's the same thing. So you just have to, a deeper level of analysis is required to see whether in fact there's that same level of support.
Yes, sir.
We're going to give you two.
Thank you. Two quick questions. So there was mention about programs to help people build savings for down payments and maintenance. So I'd like to hear a little bit more about that. And getting back to, in other countries, they have 5 to 7 year mortgages was mentioned. Is that something that we could bring to the U.S.? Is that an alternative to the 30-year mortgage?
Let me answer the second question.
Yeah, why don't you go ahead?
Answer the second question first. So the answer is, so for example, in Canada, the typical mortgage is a series of five-year mortgages that are renegotiated at the end of the term, and that's not that different from what we have here, which is what we call a 5-1 adjustable rate mortgage, which is 5-year fixed and then adjusts in the 6th year. And it was that data, those are the people who we looked at who saw their payments get cut in half and had their default rates get cut in half too.
And we do have these products. I mean, I had my first mortgage I was choosing between a 7 and a 10-year fixed, and I ended up going to the 10, and I ended up that ended up being a smart choice for me because I moved in year 9, but I didn't know that then. But that's about 7 to 10 years, 9 years average tenure. The issue is often about whether people make the choice to take advantage of the adjustable rate. We tend to we value a lot not having to know now what we're going to do later. And so the people who did the adjustables tend to do the very short-term adjustables because it's their entry route in. And I don't think there's been as much take-up in those sort of mid-length adjustables in the United States as might be rational given Paul's analysis. On the additional products, to the extent these products exist, they are tiny. And there was a lot of talk about them right as the crash happened because people were saying, well, see, if only we had this product or that product. And then once the sort of market started to normalize it, that kind of went away, and I don't see the same level of attention. I used to have a lot of people come visit me to talk about products that they were using in Germany or in Switzerland or other places. But the kind of feature, and I'm sure if you looked, you could find something like this, but not a lot. The kind of features I could imagine, there are financial institutions in Europe that will say that if you pay your rent payment and put X amount of money into some kind of savings vehicle with me for 2 years, I will promise at the end of that to underwrite your mortgage. In other words, essentially they are, now they're buying a customer, right, with that, but they are also creating a set of the right kinds of incentives so that when the person goes to the down payment, and if they know they have that mortgage, the other idea is what if you, and I think Fannie experimented with this, you lower the rate for a higher risk mortgage borrower if you have X amount of money maintained in some kind of home maintenance or rainy day fund. Because that's often one of the things that puts people in trouble. But we've always had this case. People, and I think your paper talked about the Schiller mortgage idea too, right? Where essentially people buy a product where the risk of the downside risk, they're sort of paying some sort of insurance. People believe house prices are going to go up. They don't believe house prices are going to go down, and so. When people have had the option of essentially buying some downside protection, and if it costs them money, they almost never buy it. And so the hard part is a cultural education one. Could we get people to act rationally about things that might happen that are bad to them in the future in order for them to, for example, build up that savings rather than buy the new car?
Right. Please join me in thanking Sarah and Paul for a great time. And thank you all
Fun to
for
do.
coming.